you're missing out on some deductions that you're entitled to at a corporate level. Hey everybody, this is Mitch Wilder with the Ahead of the Curve podcast.
And I'm Micah Frame.
So Micah is going to talk to us about some, is it new-ish tax laws, or it's new tax laws that a lot of people are pretty confused on right now?
Yeah, new to new-ish. It depends on the state you live in. But what we wanted to talk about today, because a lot of CPAs don't seem to understand this, and since CPAs don't understand it, a lot of their clients and business owners don't either. This is the pass-through entity tax election. Not every state did this, but about 30 states passed some variation of this legislation over the past couple years.
Okay. So tell us more, just do a quick description on what a pass-through entity is so they understand the foundation here.
Yeah, so for the context of this legislation, pass-through entities are typically going to be separate entities like an S Corp, a partnership, a multi-member LLC, that all of the profits flow through and pass through to the owners. It doesn't count single-member LLCs that aren't taxed as corporations, and also doesn't count sole proprietorships.
Okay.
So for this context, S Corps, partnerships, multi-owner LLCs is your main criteria.
Okay, and not single member LLCs, sole proprietorships, or I imagine C Corps, because C Corps.
Yeah, not C Corps either, because they pay their own tax at a corporate level.
Okay, so it impacts a lot of people, because it impacts anybody who's in one of those 30 states, and also has an S Corp, which is a lot of people.
Which is the majority of small business owners that are making 6 figures plus. So it affects the majority of our clients.
Okay. And so just to get a baseline, should we talk a little bit about what it was like before? What are people used to? Yeah,
so the important sort of context and history on this is, it used to be, if you were itemizing your deductions on your personal return on a Schedule A, you could take pretty much infinite state and local tax deductions. So that would be state income tax, real estate taxes, personal property taxes. So there were some alternative minimum tax issues, but theoretically you could take as much state and local tax as you paid, you got that as a deduction. Well, when they redid the tax code in 2017, 2 big things happened. One is that they doubled the standard deduction, which made it harder for people to itemize to begin with. But they also capped the SALT tax deduction, the state and local tax deduction, at $10,000. So this riled up a lot of people, especially people who are high earners in high income tax states like New York, New Jersey, California, because those people could very easily be paying 6 figures in state income tax, and all of a sudden their deductions capped at $10,000. So states that wanted their citizens to be able to take that deduction and thereby get less pressure to reduce the state income tax and drive them into a real budget crisis, they've been working on some variation of this for a couple of years, and then about 30 states have passed something to where it's allowing, it doesn't fully fix the issue, but on your business's profits through a pass-through entity, it allows you to pay that tax at the corporate level, at the entity level, rather than at the individual level.
Really? Okay.
So
I can see why so many CPAs don't understand it, because I usually follow this stuff and I'm like, wait, how would that work?
It's really convoluted, and we need to increase our prices anyway, but you're seeing CPAs across the board increasing their prices because it's added a lot more time and complexity to the returns, but the savings can be massive. Okay. So let's say that,
so is it, in your opinion, is this recent adjustment, is it better in general, do you feel, or is there a certain subset or market of people who it's better for and a certain that it's worse for? Because before, the previous tax laws were not as beneficial to high income earners.
If we're comparing it to pre-2017 to now, it's a little hard to say, just because it would really depend on a lot of the particulars of your income tax situation. But compared to the way it's been the past several years since they capped the SALT deduction at 10 grand, this is much, much better, because more or less what you were paying past that $10,000 has just been completely lost. You get nothing for it. And this is giving business owners an option to make a fair portion of their, make it deductible again. Okay. And since prior to 2017, you had alternative minimum tax implications where you could deduct all of your state and local income tax, but then they kind of go on the back end and disallow part of it. These are coming in as pure business deductions, which is pretty huge. So just as an example, Virginia has a 5.75% income tax rate. So let's say that somebody has an S corporation and it has $100,000 of net profit at the end of the year. Normally, the corporation wouldn't pay any tax. It just flows through at the individual level. You pay the tax there. But what it's allowing you to do now is the corporation is paying the Virginia income tax on that $100,000. You're paying at a corporate level, and then on the individual level, you're getting a tax credit for an equal amount.
Interesting.
So
Okay.
you're more or less just moving it from one bucket and one hand to the other. But by virtue of the fact that the corporation is paying the tax, you get to take that as a business deduction for the next year.
Got it.
Which the example I gave, we're talking about $100,000. So we're talking about a little shy of a $6,000 deduction.
Mhm.
That's good and that's helpful. But if you extrapolate that out and as you scale and if you're making $1 million, all of a sudden you're getting a nearly $60,000 tax deduction that was just gone
Not there
previously.
before. Right. So
So
the downside, it sounds like, is twofold. One, what you're seeing right now is it because it's new, or is it because it's complex that a lot of CPAs are having a hard time following it?
it's a mix of the two. It being
Okay.
new is definitely a big factor, but it's also the fact that it's not one piece of federal legislation. Every state has their own iteration of this.
Got
Some
it.
states don't exactly have it as a tax credit, they have it as you take it as a subtraction from your state income. So you've got different nuances of the exact mechanism of how it happens, where you put it on the return. Certain states also have different requirements as to when you need to make these payments in order to be eligible. Like
Okay.
most states are allowing you to make the payment up until April 15th, but I believe it's California. You had to make your first payment June 15th of the previous year to even be eligible.
Interesting.
So, and I think New York City or New York State, I can't remember which one, they had it to where you had to make the election by March 15th of the current year. So, especially if you're like us and you're working across the nation and you've got clients all over, you're having to deal with the caveats and nuances and
Of
different
each
mechanisms
state.
of
Yeah.
30 different states. And then since they're so new, a lot of the states, I don't, and not only are they new, but all this legislation was designed specifically to work around the federal legislation.
Right.
The whole
Right.
point of this was to
Right.
work around a law that Congress passed. So almost by necessity, it's convoluted and Byzantine. It's not
Sure.
straightforward.
Sure.
It's them.
Yeah.
It's them trying to work around it. So you add in that layer of complexity that a lot of the state tax departments and departments of revenue, we've had to call a couple of them just trying to be like, hey, not sure the mechanism for this, how to actually prepare. And half of the time they don't even know or fully understand the
You,
legislation
that's
themselves.
that's when you get let me get my supervisor on the phone.
Right. Yeah.
Right.
All around, it added a lot of time for us in preparing the returns for clients, a lot of time answering the questions, but especially if you're a higher income earner, the tax savings on this can be tremendous.
Yeah.
And
Yeah.
it can be it's so big that I can't it would sometimes it would be more convenient if you say, oh well, it's sort of a break even, it doesn't really make a difference. When things are a big pain in the butt to do, you're kind of hoping for,
Yeah.
maybe we don't have to deal with this. The
Won't have
tax
that big
savings
of an
on
impact.
this are so incredibly substantial. Sometimes you can't not do it.
It's not.
You can't ignore it.
Yeah. It's not. I mean, you wouldn't be acting in a fiduciary way in
Exactly.
the best interest of your client if you were to. Right. We're talking about complicated tax, financial news here. As we kind of wrap up this topic, because you've given a great synopsis of what is involved in this and what's happening. My last question would be, as of this recording, we just came out of tax season. What typically happens, we find, is, as we're talking to folks about taxes, I'm talking to them about it for business planning and some financial planning. You're talking to them about it from the tax side. What you and I find is that, like, as we're talking to folks, people have these symptoms right? Of like, I have this thing, I know that I paid too much in taxes, but I don't know why I paid too much. What would be a symptom, I guess you could say, of somebody experiencing this, that they need to kind of send up a light bulb or a red flag to say like, hey, wait a minute, that was me? So one is they have the S corp, they're in one of the 30 states. What would they experience if something were off about this?
The main thing would be well, and I hedge this a little bit because some states do have their franchise and excise tax at the at the corporate level anyway. But your state bill at the entity level should have either gone from zero to something, or
Okay.
it should have gone up substantially if you are in one of those states that you already have some fee that's associated with the filing.
Like, let's say, for example, one of the biggest red flags previously, when you did your corporate state returns, you would have seen a zero. And
In
now
a
all
lot
of a
of
sudden
states, yeah.
there is something in a lot of states. Okay. So that's one,
Yeah.
one indication.
So if you didn't see that, if it just stayed zero and your CPA or taxpayer didn't talk to you about it, or you're doing it yourself, if you're in
Then
one of those states,
what could be
you
happening is you're missing out on some deductions that you're entitled to at a corporate level, corporate and state
yeah,
level.
absolutely.
Yeah.
And again, like basically everything we talk about, this is relative to how much money you're making. But if you're a high income earner and you've got a really profitable business, the cost of missing this one thing can be massive.
Yeah.
It can be huge.
Yeah. This is, yeah, super fascinating. What's this called again? You said it's the pass through entity tax election. Is that right?
Yeah, yeah.
Okay.
Most of the time they'll abbreviate to PTE or PTET.
PTET.
And then some states call it the SALT parity
Okay.
election, but if you search for that, you'll find it. And I think the AICPA has a graphic. They have all the states, and they have the proposed legislation, and they're linking to the actual source documents
Okay.
for the proposals. So
We'll get that linked all below. In addition to that, like sometimes you're just not sure. It's kind of funny when we talk to people about this. When people when people have a problem with their accountant or their CPA, they don't want to talk to their accountant or CPA about that problem. They want to get outside advice, and that's totally fine. So we've got a couple ways that we can help you do that. So one of the ways, we'll put a link down below to see, so that you can see, if you have an S corp, you have a multi-member LLC. Did you say an LLP also?
yeah, LLPs.
Okay.
You can also have just straight partnerships
Straight partner.
would
Okay.
also.
So if you have one of those types of corporations, especially if you're a high income earner and you're in one of those states, you're going to want to get a second opinion on, is this something that is impacting me? How much, am I entitled to? How much could I be missing out on? Just to get a third party, viewpoint. If you want to connect with us about that, we're going to put a link below in the calendar. Find a time with us, tell us a little bit about your business, and we'll just answer those questions for you, help you understand. And if it's something you feel like we can help you with, then of course, Micah and I and Micah's team want to be able to do that for you. All I can do is help to make sure that you're in a position that he and his team are going to be able to help you. But we want to be able to do that. We also have a link that I'm going to put down in the description here to the Ahead of the Curve community. So we just officially launched this, the Ahead of the Curve community. It's currently a small community, but it's actually growing pretty fast. We've had several members added on this week. I expect to start seeing members, coming into their new members every day. What's nice about this group is when we get to 100 members, which we're going to be very close, it's not going to take long, we're going to have a way for you to get questions answered about things like this, about things like taxes, like accounting, from Micah. We're going to have Ask the CPA, open office hours where you can jump on a call with us, ask some questions, and get some answers. Just get some straightforward, unbiased answers on your circumstances. And we're going to have those calls monthly. In addition to that, we're going to have other calls. We're going to have other calls with professional advertisers, marketers, business consultants, all kinds of people that we're bringing into this group to help answer questions. And the cool part is it's all free. Okay. So there's going to be a link to that down below this video. We'll have the link to the calendar. In addition to that, we'll have any other resources that we have in the show notes below so that you can get help with these things. And if we can help you, we look forward to talking with you. And Micah, I appreciate the education on this today and helping everybody to easily understand what is going on with this, what's admittedly a very complicated tax law. You made it really easy for us.
Oh, Hope so, at least.
Oh,
But if not, like you said, it's easy enough for us to hop on a call and clarify for people's specific situation.
perfect. Well, I appreciate it. I'm sure everybody else does. And any questions, post them in the comments below or hop on a call with us, and we'd be happy to answer them. Thanks, everybody. I say as Mike is taking a drink. All right. Signing off until next week. We'll see you then.